You're listening to Ready, Set, Go Real Estate Investing Podcast, presented by Brandon Elliott. This show will be going over all aspects of real estate investing and is intended to educate, motivate, and prepare you to take action on your first or next real estate investment. For more information, please visit BrandonElliottInvestments.com. Thank you for listening and enjoy.
Welcome everyone to Ready, Set, Go Real Estate Investing Podcast. I'm your host, Mr. Brandon Elliott. I'm excited to have this gentleman on today with us. You know, it's a unique, different type of strategy is what I would say. Really private equity, building generational wealth and setting yourself up with more protection, tax benefits, you name it, right? Dave has been doing this for a good amount of time now and set up his book last year called Holistic Wealth Strategy. It really focuses on finding and curating those operators to be able to build up these big companies and syndications, mobile home parks, multifamily, a bunch of different businesses, right? And even right now, I believe it's 2.6 billion in equity partnerships that you're a part of in some form or fashion, right? So this is a very high level type of approach, not just the regular average couple real estate type of deals, which is awesome. You focus on family offices as well and teach people and help others do the same thing. Is that correct, Dave?
Yeah, correct, Brandon.
So talk to me, for anybody out there that doesn't know more about who you are, where you're from, your background, and how the heck you got started into something like this, I would love to give that information to the listeners.
Yeah, absolutely. So I was raised in a middle-class family, probably like a lot of the listeners out there in Connecticut. And I was told that the recipe for success was go to school, get good grades, you're going to get a job, and life would just work out, right? So I kind of followed down that path and then had the opportunity to do the ROTC program in the Marine Corps, did 4 years in the Marines and got to actually serve my country, see combat, travel the world, and also learn some things they don't teach you anywhere else in the world, things such as leadership, teamwork, and integrity. After I transitioned from the Marines, I got into corporate America, and I was quickly frustrated, Brandon, with like losing that sense of purpose, that sense of mission. And then at the same time, my wife and I had an 18-month-old, and on October 24th, 2000, we literally welcomed triplets into the world and quadrupled the size of our family overnight. So if anyone out there has a family, if you have kids, whatever ages they are, just imagine holding 3 babies in your arms at the same time, right? And I can tell you that the paternal instinct in me was running so strong. And the first thing that was really going through my mind, Brandon, was, how am I going to provide for financial security for my family? I mean, I'm 26 years old and, just trying to start off on my career. Retirement seemed like, it would never happen at that point. So I went to see my financial advisor, right? And we had a meeting like the next day. And then he told me that, he gave me this advice to just max out my 401k. They have things called 529 plans, would get some state tax savings for my kids. And, that was really the plan. That was it. And
was that like an Edward Jones type of,
completely. Yeah,
okay,
completely.
Gotcha.
And so it was right then that I knew I wasn't going to build wealth, right, as a retail investor in the stock market. So this launched me on this obsessive journey to really figure out how are the top 1% and 0.01% actually building their wealth. And so I started to invest in all kinds of different asset classes, everything from single family to multifamily to oil and gas, alternative investments, all kinds of different investments. I read, I did as much learning as possible. I networked like crazy, tried to meet a lot of people and studying different, PE firms, family offices and such. And then, fast forward 20 years later, I really founded Pantheon and wrote my book, The Holistic Wealth Strategy, to figure out, to help other people figure out this whole game. What is the roadmap, right? You may have read Kiyosaki and said, passive income is for me, but how do I do it? Getting into this real estate game is a lot harder than I thought. It's a full-time job. What is really the strategy? So the holistic wealth strategy is just that. It's really a playbook for how you can actually become truly wealthy and create that financial independence everyone's looking for.
I love that so much. Yeah, when you get into real estate, you start getting some cash flow, and then you're looking for passive income. You find out it's not as passive as you think when you still have to handle tenants or property management, even managing them. And so sometimes that there's more time, energy, efforts in there than you initially thought you were signing up for. So talk to me I don't want to spoil everything in the book and steal from it. I definitely encourage listeners to go and check out the book. I'm sure they can find it on Amazon.
Yeah, 100%.
Okay, awesome. So Holistic Wealth Strategy, find it on Amazon. Go get that right now. But give me some breakdowns of, details in the book that the average American just isn't aware of. It's not being taught in school. It's most likely not being taught around the dinner table. So how is this even possible for the average person to actually start setting themselves up for real wealth?
Yeah, I'll unpack that, but I will throw in, I wanted to give your audience a gift, Brandon, and just so you talked about it right up front. If listeners go to holisticwealthstrategy.com, you could get a free digital download of the book. So happy to get that out to your to the audience.
I appreciate that.
Yeah, so it really starts with the first thing is actually creating a vision for yourself, right? As business owners, if you're an entrepreneur, that's one of the first things you do. You create a vision and a mission, and everyone's on board to what you're going to achieve. But often in life, no one really has a plan for where they're going. And if you don't have a target, you're going to miss every time, right? So trying to define that, if you had $1 billion in the bank, right? What would you be doing? Who would you be with? Where would you be, right? Getting crystal clear on what that actually looks like. What is the quality of your relationships? What are those things that are really important to you, and making sure your spouse, your family is on board for that as well, right? Because that's what helps us bust through walls, get through downturns and unexpected events that life just, has for us all the time. And once you can get clear on that vision statement, we start with phase 1, which is all really about mindset, Brandon, right? And so many people, I know we love to talk tactics and strategies and real estate and investing, and we want to jump into that, and that's all fun. But I'm telling you, if you do not have mindset right, you are never going to get here. So just think about it. Most people, if you have a fixed mindset and you think you know everything, or, you're talking to your brother-in-law who says, hey, he's a financial planner or giving you guidance, and you think you got it all figured out, that's the wrong approach. You really want to be a lifelong learner. Everyone is learning all the time, right? Even the greatest of the greats, right? Like Michael Jordan, you name it. They're still practicing and honing their trade. So having that growth mindset where you can then start to create goals, you can create habits that support those goals, and you're really looking at yourself as the greatest asset, right? Because I've always been able to get a 10x, 100x return anytime I invest in myself. Things like listening to great, shows like this, reading books, being a part of masterminds, that's where all the value starts from. It's the greatest real estate is that real estate in between your ears.
So good. I love that. I'm a big advocate of investing into yourself for many reasons, getting around some of your best friends, other people that care just as much as you to get to that next level. A lot of us have the same backgrounds or wild stories. And also I've never wanted to have money on a pedestal. Growing up, we all have some kind of limited belief around finances. And I used to put money on a pedestal, and it was one of those things I had to actually pay attention, to humble myself and say like, hey, I don't want to have these limitations anymore. So I had to get comfortable being uncomfortable and investing in myself and demanding that ROI, right? And eventually it just starts coming back to you. So big advocate of that as well. Talk to me, besides mindset, I think that's a great start. Everybody has to start with that, right? Afterwards, investing in themselves and kind of getting to this next level. Like, how did you find yourself in this position now? Obviously, talking to that like Edward Jones type of investing options back then, it wasn't the right approach. Where'd you get the proper education to take it, further the right way?
Yeah, I think I really look at the investing world as an entrepreneur, right?
Yeah.
An entrepreneur, right, takes something of a lower level, right, of efficiency and brings it to a higher level. So, I started asking questions, things like, does it make sense to defer taxes, for instance, right?
Yeah.
So people are putting money in 401ks, which is their main source, and yet you're going to pay the highest amount of taxes on that when you retire. And the only thing that I'm likely certain of in life is that taxes will be going up in the future, right? So why do you want to defer that? Why not pay taxes on the seed rather than the harvest, right?
Sure.
So starting to come to some conclusions like that. Also realizing that, again, you start to get into some 60-40 type split of stocks and bonds, and you're 100% exposed to the stock market, right? So looking at other things like real estate, where you can get what I call basically a trifecta type return, where you go after assets. This is our investment thesis, is that we're looking for assets that are non-correlated to the stock market and have basically three different components to them. One is they've got tax efficiency to them. The second is passive income stream. And then the third is forced appreciation, right? Where you're driving value into the asset, right? And that could be businesses, that could be mobile home parks, self-storage, multifamily, you name it, right? But that, as compared to, let's say, $10,000 worth of Tesla, the only thing you're really hoping for with a Tesla is that it's going to go up over time. It's very linear in nature, right?
Sure. That makes sense. Talk to me, how do you feel about stocks and crypto, for example, right now? Obviously, we're kind of in one of those seasons that there's a lot of hopefulness for crypto and, in this kind of more of a bull market. But talk to me, what are your thoughts on this?
Well, you just called it right there, right? You said hopeful. And last time I checked, hope is not a strategy, right? So inside some of the world's best family offices, basically the aggregate is about 1% to 3% right now that are allocated to crypto, overall in terms of family offices, right? So I believe in it. I came out of the tech sector. I believe in, underlying utility of crypto, especially things like Ethereum, right? So, and now, Bitcoin has gone far enough that, and with institutions coming in and regulation being passed, the Genius Act just got passed recently, right? So I think it's definitely here to stay, and it will become less volatile, right, as that goes. And it is a limited, there is a limited quantity of it. So I would have some exposure to crypto. That's just my personal opinion, from that standpoint. But investing is really a process. And like I'm trying to point out with this strategy, that is one of the biggest missing links we find for people, is that no one has actually a true investing strategy. They're really just kind of hoping, right? Or they're putting it in the market and they're saying, hey, I've done diversification, which is really you're averaging all these non-performers. And at the end of the day, maybe you're making about a 7.5% return, but that's before taxes, fees, and inflation. So true diversification would be starting to get into alternatives in real estate, which is really how you see most family offices and high net worth individuals, right? They have, I would say maybe around 25% exposure to the stock market, and that's it.
Gotcha. I love that. So a majority of investing that you like to do as an entrepreneur and that you're an advocate of really has to do with the main three: tax benefits, cash flow, and appreciation, either forced or natural.
Forced,
yeah.
Because if it's just appreciation, then again you're into that hope, right?
Yep.
What's so great about real estate is, you can get a multifamily asset, right? And it's like you can buy it, and now innovative, use innovative ways to drive revenue. Like, let's put in a pet park, and now we can charge, another $75 a month, right? To give value to the tenants, right? And create more value, right? So that's forced appreciation.
I love that. And being that it's multifamily, even just renovating it and making it nice, treating multifamily as the true business that it is, and the operating expenses, bringing those down, increasing your overall income and so forth. That's how you're actually getting these multiples and forcing it. Talk to me when it comes down to family office, just so anybody that doesn't quite know what you're referring to with that, do you mind giving more of a breakdown and a better understanding for the listeners?
Yeah, absolutely. So it's really interesting. The family office market actually globally is, one of the most diverse things that's out there, right? There's so many different structures and different focuses, but typically they're for high net worth, ultra high net worth families that have made money, whether through businesses or maybe through legacy. And they basically create a business out of their wealth. And in that business, you want to structure a team around that wealth. So people who are doing estate planning, they're doing asset protection, risk management, obviously doing your investment, making decisions around your investments. There could be a complete philanthropic role with that. And some people like to do, investments around, let's say, sustainable type of investments, or, something that coordinates to their passion, right? So that's really it, right? You're creating a business around investing. And my philosophy is that even if you have $1 million and not necessarily 100 million, you still need to be thinking about this. Right. Sure. So, in the holistic wealth strategy, we talk about, creating an infrastructure around your wealth, and also creating a dream team. Right. And with that infrastructure, for instance, right, you may have had some guests on in the past that talk about infinite banking. Right. Yeah. As a strategy. Right. Yep. So what a great strategy, right? That you can take over the function, the banking function. You can have more liquidity. You've got part of an estate planning plan. You have tax-free growth. Right. You have all of these multipliers really by setting that up as part of your infrastructure. Another massive component is actually tax planning. OK, and I'll make a very clear distinction between tax planning and a tax preparer. Most people don't understand, but tax preparers are typically, if your CPA is just asking you for all your documents and filing things, you've got a preparer. And all he's going to do is tell you what you owe. But if you can find the right, and in my journey, it took me many, many years and firing, many, many CPAs until I finally figured this out, and paying big 6-figure, tax bills, that if you work with a planner, you can actually proactively create a tax strategy that's really going to minimize, your taxes. And think about this, Brandon, right? This is the biggest untapped opportunity for people out there, whether you're a W-2 business owner, I mean, you name it, right?
Oh, yeah.
We're all looking for the biggest return on our investment, like whatever it is, 10%, 15%, 20%, that's great. But what if you could reduce your taxes by 10%, 20%, 30%? You live in California and you're paying taxes. I mean, we have so many investors, high income individuals that are just paying through the teeth, all of these different taxes, right? So if you can create the right strategy and learn how to actually understand the tax code is actually a roadmap of incentives for business owners and investors who know how to access it. So investing in things, as an example, in oil and gas. So we have oil and gas opportunities where up to 100% of your investment can actually offset active income.
Wow. I love that. Talk to me about just to pump me up for a little bit. What's one of your most exciting investments, and what kind of return roughly have you seen on that? And then I want to hear about the worst one too.
Yeah. So great question. Yeah. So the best one is something that we have right now. We've been running for almost 3 years, which is actually private credit. And it's interesting because private credit is starting to get really popular. You're starting to see it in like real estate and things like that. And actually billionaires have been finding this nice niche of where they're allocating, up to 10% of their capital in private credit. And the fund that we have is super interesting, right? We're actually providing lending to small businesses who actually need capital because they're growing. Think of it kind of as like hard money lending to businesses, right? Yeah. Kind of like real estate. So, great example, right, is, we're in Florida here. So we had a hurricane last year. You've got a roofer. He's got a year-long backlog of work, but he can't get access to new materials and equipment to service, the demand that he has. So he's going to pay a premium, get access to capital that he's going to pay for, but now he's able to capture that business, then pay off that loan. Now, on the other side of this equation, what's fantastic as an investor is the average loan size length is only 7 months. So we're actually, the velocity on this, we're getting paid before, as the vendor his clients are paying, we get paid daily and interest, daily and weekly principal payments that come in. And so this is able to be accrued. So as soon as a dollar comes in, we're actually able to put it out into the next opportunity. So this creates an amazing amount of velocity. So yeah, investors can do a cash flow from 12 to 15% cash flow on that. Or if you want to do the growth class, right, there's no cash flow on that, but it's a 5-year hold. And that's, in the 20s, 20, 25% type return on that.
Wow. Now, is there certain, sure, there's a ton of laws and restrictions and things to comply with, but is there certain rate caps that you can request with these hard money business loans?
So I think the way we kind of really hedge here is that there's institutions in this, like very big ones that you've heard of on this platform. Okay.
Yep.
But what's really interesting about this world too is those institutions, just because their name is on it, they can give, a 9 to 12% return, and people think, hey, that's great. My money is safe, right? Well, we don't have that overhead, so we can pass it on to the investor, which is great. But we never take more than a 5% position in any given loan. So we're kind of hedged there. We're also hedged in that we're invested in upwards of 20 different industries. So even if like hospitality took some big hit, right, we don't have that much exposure there. And then we've averaged the whole fund is averaged about a 6.5% default rate, even through the pandemic for the past 8 years. It's pretty low, right?
Yeah, that's pretty damn good. Yeah, that's awesome.
Yeah.
So talk to me, what is, if you don't mind sharing, because we always love to learn from some learning curves, right? What were maybe one or two messy ones that you're just like, man, I wish I didn't have to go through that pain again. Still, I'm sure you're like me. I don't live with regrets on it, but I'm glad because I went through that. I learned how to get to the next level, but you're not going to make that mistake again.
Yeah, so we're not operators, right? We partner with, best-in-class operators who we believe have, really strong competitive differentiation in certain markets. But we had access to multifamily opportunity in Atlanta, and great business plan, knew the sponsor, great balance sheet, amazing track record, like entire career of track record. And we got in and we were not, this is right around the pandemic era, just post-COVID. And the jurisdiction, I think it was the county level jurisdiction, we could not evict tenants out of the the
And they knew that, so they're taking advantage of it. And
exactly. And then they started telling it to all the other tenants.
Oh, yeah.
Too. So then it just kind of spread. And we could not get the tenants out. Yeah.
So how long did that take until like something gave? Or
that was like an 18-month. I mean, we were going court battles and things like that. So trying to figure that out. Yeah. So that was messy. And I think, we've improved, our investment committee and our underwriting in terms of due diligence, right? To always be really investing in, I think this is really important to invest in states that are very landlord friendly. I was just talking to someone earlier today, and he's talking about New York, and they found a great asset there. And I'm like, yeah, I would never.
My heart breaks for you.
I'm sorry, I would never be, investing there. There may be some great projects in Manhattan or something, but states that are not landlord friendly, I would not invest in for particular reasons like this.
Oh yeah, yeah. So that's a huge learning curve that many unfortunately went through after the pandemic and during that process and so forth. And that's really, really good information, because as you're searching as a new investor or just, trying to get some assets under your belt, it could be in where you live, like your own backyard. I live in California. It's a tough state for investing in certain cases. So you just need to be aware of these things. Doesn't mean that I'm, packing my bags and I'm out of the state. I have assets out here as well, but you definitely want to be strategic and understand the pros and cons and have backup plans and so forth. So that's a really good learning curve. Anything else that you would want to share?
Yeah, I mean, I think the other, real takeaway right now, especially on the real estate side, with respect to multifamily is, a lot of the deals that were underwritten 21, 22, this is, not only just, multifamily, this is like all of office, like this is almost 90% of the commercial market where everyone was using floating rate debt, and the banks underwrote to that and approved that. I mean, that's how the industry worked. And so, everyone is now, a lot of those deals, great operators, people with great track record, deals that have been performing well, just cannot, manage the debt, right? So, there's a lot of lessons there. So one, as an investor, never put all of your eggs in one basket, right? Into one operator, into one deal, into one market, into one asset class. You want to try to diversify right around. That's super important. And then, really understand what the debt looks like, right? That is like one of the single biggest components to an investment, right? If it's, 80% of your investment in the capital stack, you really want to understand what the terms are of that debt and everything, and be able to provide as much wiggle room as possible for the operator to have, room to be able to pivot given, a market or whatever. But that was completely artificially manifested by the Fed.
Sure. Oh yeah.
Yeah.
Yeah. It's a mess. I'm part of a syndication in Arizona, good, amazing operators. And unfortunately, just like a majority of people, just betting on the floating rate, and yeah, there's been several capital calls just to keep it afloat. And there's probably going to be at least one or two more in the next year or so. And if you had all your eggs in one basket, obviously you wouldn't be able to be accredited and to a certain degree to get into it. But some people go all in, right? And you definitely want to diversify. You want to have backup plans. You just want to be protected, right? You don't want to go all in on just one thing, because it is investing, right? And so investing, there's no guarantees to anything, right? So you want to definitely do your due diligence, have backup plans, and just be prepared and be resilient, overcoming whatever comes your way. When there's a will, there's a way. There's always, when these troubles come up, how are you going to deal with it, right? When you have a good operator in place that isn't like curling up in a ball, and you're willing to mastermind and brainstorm with others, then usually you can push through. So I love that, Dave. Talk to me, anything that you're really excited for right now within the market, opportunities that you see?
Yeah, so one thing we're super excited about, Brandon, and actually I can throw this out there for you and your audience too, is so as part of this journey, right, when I kind of got into this world of investing in alternatives and real estate and trying to I wanted to grow my wealth. Like, look at the rule of 72, right? Which is how quickly you can actually double your money. Well, if you're just exposed in the stock market, I mean, it's 7.5%, it's going to take you quite a while. Well, if you can get a 20% return, you can double your money really every 5 years. So outside of having 53 different spreadsheets, how do you track, your passive income streams, your balance sheet, right? All of these different things that are, happening. And so I have always wanted to really kind of make wealth building a process, right? It's a process. And then how can we operationalize it? So we actually just built a software product called Pantheon Wealth OS, which will actually aggregate all of your assets. So you can look at crypto, you can look at real estate, you can look at your syndications, you can look at all your traditional investments and then say, you know what, I want 3% in crypto. So now I can actually, see it really here. And by the way, I can use AI to forecast and model and simulate. I want 3% now, but by the time I'm 52, I want to have it at a 7% allocation. Right. And so now we're able to have the power of doing that. And then we can also project passive income modeling and look at all of your passive income to know that, hey, if your freedom number is 100,000 or 200,000, that you can become financially free. Well, how do you track that? Well, we can track all of that, and it's all charted out and everything so that you can get there faster, right? Without having the visibility, it's just, it's a guessing game. Sure. So we're super excited. We're launching the next full revision of that. And we're actually, for the first 100 investors or users who really kind of come onto the platform, we're giving away some free access. And you can go to pantheonwealthos.com to check it out.
Let's go. I will be one of them. So that's awesome.
Awesome.
Yeah. I got the cheat code. I'm like first in line right here. So this is good. That's so awesome, man. Thinking about, I know nobody has a crystal ball, but what are your thoughts on rates in the near future?
Well, yeah, the crystal ball, that is always an interesting one. I ask people that on my podcast as well. But it is pretty interesting. This, game of chicken that, Powell is having with the president is quite interesting. So we'll see. I think there is a lot of pressure to actually adjust rates downward. And I think that would be great for the economy and for real estate, definitely, to come down. But at the same time, then, you have the flip side of that, right? Which is, inflation and really debasement of the dollar. So we can't really control interest rates. And again, there's been times where it's been over 12%, right? So where it is today, it's actually super low. If you can actually get a deal to paper, then you got a good deal, right?
Yes.
And it can only get better. So the best way I would answer that as an investor is, number one, don't understand in your due diligence that interest rate risk. If you have interest rate risk, again, not putting all your eggs in one basket. This is a good way to diversify into that private credit fund that has no interest rate risk, as an example, right? So that's how I would think about it. And then also, if you are doing deals, try to make sure that the deal works at today's rates so that if it goes down, you only get better. But don't be relying on some of these operators to we're going to turn a profit, next year once rates come down 2 points.
Don't do that.
Yeah, don't go
that.
there. Please.
Run from that.
Yeah.
I really feel like we got so darn spoiled. We got so spoiled for so long of having these ridiculously low interest rates that really weren't sustainable. It's like, in the 90s, there were interest rates damn near to like 20%, and so again, like you were mentioning, if as you're an investor, as you're doing your due diligence, if you can make money today on a deal with the interest rates today, and you can lock something in, and you're pessimistic and you think the rates are going to go up more, great. You just locked in and you're making money on today's deal, on today's rate. If you are optimistic and you believe it's going to go down, great. You still locked it in and it's making money today. It's going to make more hopefully in the future when you can refinance and so forth. So, but basing it off of today, making sure that you're making money, you're getting tax benefits, you're getting the forced appreciation and hoping for something in the future, great. Just you shouldn't be investing on hope, like you mentioned. So I really do love that.
Yeah, can I add something to that as well, Brandon? I just had a really great economist in, Daniel LaCalle, and we were really talking about really the future of the dollar. And there's a lot of people out there that, just talking about the demise of the dollar and everything, and fiat currency. And, he made some really interesting points that, it's not going to happen like overnight, like all of a sudden the dollar, right, implodes. And the dollar is really not going anywhere, nor are, some of these other currencies.
Yes.
But what is happening is actually debasement of fiat currency. Right. So the value of the dollar today in 2025 is a lot less than it was in 2020. Right.
Sure.
So with that being said, as a savvy investor, what you want to be doing is aligning your investments, right, that will hedge against that in the future. So real estate is a great investment where you're buying that asset that is actually going to grow over time, right? So it's a hedge against inflation. And then secondarily, something people never really talk about, but is very strategic, is that you're paying off that debt that you sign up for today in future dollars, right? Which are basically worth less.
Yeah, that's so good. I love that. Anything else that you could leave with the listeners before we get out of here? I do want to give you an opportunity to share how people can get a hold of you too, if you don't mind. But anything else that we might have missed today?
Yeah, there's another really important piece here, and in phase 4 of the holistic wealth strategy, we talk about asset repositioning. So folks out there are kind of listening and say like, wow, this is kind of interesting, right? I mean, hopefully you're kind of sitting in your car being a little pensive right now and saying, wait a second, maybe I can increase my yield, right? Maybe I can do some different things. So in phase 4, we talk about asset repositioning. Over 90% of Americans have their capital in 2 different places. One is trapped equity in their primary residence, and 2, in government-sponsored qualified plans. Okay? Yeah. So let's talk about the first one, trapped equity. The rate of return, this is not a riddle, but the rate of return on equity in your primary residence is 0. Okay?
No riddle here, ladies and gentlemen.
So, if you're a Dave Ramsey fan, that's fine. But I can tell you, if you're trying to, achieve like quicker wealth, right? Very responsibly, but still, taking on a loan to value that you could be comfortable with, you could deploy that capital. Let's say you're paying 7% on it. You get a home equity line of credit, put it in something like the credit fund that's doing over 20%. Pay the debt service back on it, and now you've just created over a 14% return out of nothing. And by the way, you've also done 2 other things, which is increase your mortgage interest, right? So you've reduced your taxes with that, and you've now made the bank have a higher percentage of ownership in your property, which means that you actually have less risk in that property.
Yeah.
Right?
Come on.
So that's one. And now let's talk about government-sponsored qualified plans. Like, I'm sure your audience has heard about self-directed IRAs. That's one avenue, right? You're still in that IRA vehicle, but nonetheless, a good approach. Again, you're making 7.5%. You put it into this thing making 20%, and now you're doing a lot better. Plus, you've diversified. Other options, we literally built, you'll love this, about 18 years ago, I built a 401k exit calculator, and I've actually done the math. So you'll love this, Brandon, right? Okay, so here's the high level. Let's say you take 100K that's in your 401k. You pay the 10% penalty. You pay 35% in taxes. You now have a $55,000 net investable amount. Yeah. Okay, I invest that for the next 20 years in, say, real estate syndications that are tax efficient and doing a 20% return. Guess what you think that will be in about 20 years, the compounding from that?
What is it?
It's over 2 million.
Is it?
Yeah, it's over 2 million.
Let's go. Come on.
Okay, now let's compare
compound
that
effect
to,
is so amazing.
If you leave it and don't pay the fees or the taxes,
Yeah.
Okay. Your 100K is uninterrupted, still grows at that 7.5%, what the S&P is typically doing over 20 years. It's about 286,000, actually, no, 386,000. And then you have taxes, fees, and inflation on top of that.
Yeah. I was generous. I was thinking to myself, it's got to be maybe around 400,000. No, it's even worse. On top of that, all the taxes and inflation. Oh my gosh.
Now, disclaimer, I'm not a CPA or financial advisor, but the point here is really important. Start asking the right questions, do the math for yourself. And make some assumptions for yourself, because even if that scenario is only 50% true, in the first scenario, you're still going to do better, right?
Yes.
So this is, the importance of this phase 4, where we're trying to just take the existing assets you have. How can we reposition them to get greater yield, more diversification, and lower your risk at the same time?
Yep. And guys, by all means, do your own due diligence. Like the saying, people lie, numbers don't. So play with the numbers, actually do your own due diligence, and the numbers won't lie. And so there's power behind actually doing the math on this stuff and seeing the difference, because we get caught up in this. I wouldn't call it a lie, but it's not in your favor if it's only going to serve you 7% and you're paying taxes on it, and it's only a couple $100,000. And maybe that's good for some, but what I can tell you is that there's other alternatives out there, and you deserve it to yourself, for your family, for your future, for your finances, to actually see these other alternatives so that you can be blessed by it. It's that simple. So I love that. I'm super grateful that you came up with a calculator for that and did the math for us, because I know that can be a pain. So
it's going to be in the software too.
Is it?
It's going to be totally embedded in the software. Yeah.
Come on. Do you mind sharing just a couple of the links really quick again? So the software and then the book, just so people can be aware of it.
Yeah. So the book is holisticwealthstrategy.com, and the software is pantheonwealthos.com.
I love it. And guys, you can get the free digital copy by going to the website, holisticwealthstrategy.com. But then afterwards, if it blesses you and you find value in it, go financially bless, share a review, go on Amazon, get the book, get the physical copy, bless somebody else with it, and share the message. Okay. Dave, how can all of our listeners get a hold of you?
Yeah, that's really the best place. You can find me just about anywhere, LinkedIn, email, but just go to that and you get a copy. We want to give value first. If we can help you with anything, this is what this is all about. I've spent, 25 years really going through this journey, and I want to help other people really accelerate this with the knowledge, the tools, and the frameworks that we have.
I love that. I could tell the pain that you had when you were talking about, the bookkeepers, tax filing, tax preparation, all the things. I felt numerous times over the years as well, the same stuff, going through 8+ different people that I thought at the time they were the ones finally. And you come to find out just a little bit later, they're not the ones, right? So anyway, I love that. I appreciate you greatly jumping on today. Guys, definitely reach out to Dave. He is a wealth of knowledge. He's got his heart in the right place to be able to serve you. So take advantage of those different resources that he provided today. If you have any questions, reach out to him. If you guys want to get a hold of me, you can do so on Instagram. It's Brandon Elliott Investments, or our business page, which is Credit Counsel Elite. If you're looking to get funding for your business and get rates as low as 0%, something that can be repeated every 6 months per person, you'll have the option for that. And as much as up to 500,000, I'm talking 200, 300, 400, or even $500,000 plus. We have some webinars going on this week, next week, and then a 3-day virtual event on August 1st, 2nd, and 3rd. You're not going to want to miss. So you can simply reach out to us. But go to creditcounselelite.com. That's creditcounselelite.com. And you can book a quick call with us or get some more information there. Anyway, guys, love you all so much. Tune in to the next episode next week. Hit that subscribe button, leave a review, and we will see you next time. Thanks, Dave. Appreciate you.
You bet. Thank you.
God bless, guys.
This has been another episode of Ready, Set, Go Real Estate Investing Podcast, brought to you by Brandon Elliott. For more information, please visit BrandonElliottInvestments.com. Also, please don't forget to like, share, and leave a comment below. Thanks again for joining. Until next time, God bless.